Hi everyone, I'm Bernard Young. I've just been introduced, and I would like to welcome you all to ABFER 2022 main conference. After 2 years of COVID, I'm really delighted that we eventually managed to host a face-to-face meeting tonight. Virtual meetings can be effective. However, face-to-face means we can catch up with our old friends, and we can produce a lot of instantaneous and exciting exchange of ideas. And actually, I saw some of this today. But I do have to apologize because of the COVID situation. We still have to practice a lot of caution. So my apology that we left you out there, cannot serve you any cocktail or anything like that. But they are coming now, I am sure. You can see that they're delivering drink now. Well, this year we have a very good conference program. We are selecting from 300 very high quality papers comprising 850 authors. Thanks a million for your support. And my apologies to those who have great papers, but we are not able to accommodate them all. We wish we could. The program is really very exciting. I've been sitting through the whole day. The next few days will be the same, that there's all this learning and exchange of ideas, and it's really wonderful to have this opportunity. I want to thank the authors, the discussions, the program directors, and organizers, and conference organizers for the excellent work. I also want to thank our keynote speakers, the masterclass lecturers and moderators. The intellectual energy really can light up this room, but we are hot enough. I want the energy to turn on the aircon. A bit of a history about ABFER. It was conceptualized in the MAS Finance Research Council 2013. MAS Managing Director Mr. Ravi Menon and NUS then President Tang Cho Chuan and the like of famous people you know, like Professor Robert Merton and Martin Feldstein, encouraged us to proceed. The objective is to build a network to facilitate high-quality research relevant to Asia-Pacific that can inform practitioners and policymakers here. And also the network aims to raise the recognition of the community's high-quality research. Since then, 2013, except in 2020. And last year we did virtually. We have held NBER Summer Institute-like annual conferences and the Asia Monetary Policy Forums and many e-seminars and conferences. We look at the statistics. The latest show that more than half of the presented papers are on Asia-related topics, and also more than half have an Asia faculty as an author, and about 35% of these papers are included in top-tier journals. Seeing Asia-Pacific context-based paper using Asia data appearing in top journal is really a very gratifying experience. I'm sure you feel the same. That's why you're here. Today, I'm really glad to hear that some senior faculty comment presenting in ABFER conferences, workshops, or forums are really becoming a quality signal. It is also an excellent opportunity to scan top research relevant to Asia-Pacific regions. At this point, I really want to thank MAS and NUS for their financial support, and Andy Rose, NUS Business School for hosting the operation. We are also grateful to the Advisory Council members for their guidance, and we want to thank the senior fellows, they're sitting here, the executive committee, the program chairs, and workshop organizers for the excellent work and commitment to ABFER. You are ABFER, and thank you very much. I want to thank the Amin team for the excellent work on logistics. I think they have spent many hours working through the night, not sleeping, and I know that some of them had COVID and they work from home, but despite COVID, they're still working to prepare for this conference. So thank you very much to them. Tonight, let me introduce our keynote speaker, who is indeed helping us despite his recovery from COVID. Let's welcome Dr. Amit Seru, the Stephen and Roberta Danning Professor of Finance, Stanford's GSB, and Senior Fellow of the Hoover Institute, and Senior Fellow of Stanford's Institute for Economic Policy Research. And before Stanford, he was a professor at Chicago Booth. And we're very proud that Amit is also an ABFER Senior Fellow. Is Amit online yet? Hi. Are you able to hear us? Can you see us? Great. Amit's great research is well known to us all. He advanced our understanding of financial intermediations and regulation issues. He has also contributed tremendously to corporate governance issues, connecting incentives, organizations, investment, and finance. His paper has appeared in top economics and finance journals. He's a co-editor of the Journal of Finance and an associate editor of the JPE. Amit's keynote is on technological disruption on modern financial intermediations. Many of us are here tonight because of the attractive topics and the chance to learn from Amit. Besides the crowd here, we have many online eagerly waiting to learn from you too. Well, Amit was down with COVID. I received a message on Tuesday morning last week, and he had to cancel his trip to Singapore. Just as I was worried, I received a message from him. He said, I think I can do it despite the situation. And watch out that this is right now 3:30 a.m. in California time. Wow, still he's doing it. Amit, what a hero. Ladies and gentlemen, let's give him a thunderous round of applause. We are so grateful. Thank you, Amit. Yours.
All right, so thanks again, Bernie, for inviting me, and sorry that I can't be there. Still recovering. Hopefully everybody stays safe. And I thought that I'll discuss with you something that I worked with my collaborators listed below on the topic of technological disruption of financial intermediation. I know that there are drinks and dinner there, even though I don't see you in right now, but I can imagine. And I don't want to be in between you and the fun that's going to happen. So what I thought I'll do is talk about 3 or 4 things. I want to talk about the different kinds of activities that technology has impacted in intermediation, give you some examples. I want to then talk about how fintechs have had a pretty standard playbook, which expands their reach from the activity that they start out with, which is they unbundle banking services in some space, and then they bundle in some other space. So that's a standard playbook. I'll talk about that. And then I want to talk quite a bit about challenges that regulators face and various economic forces about banking and intermediation that we can take from whatever we are seeing and learn from, and then conclude with some open questions in the end. So that's my plan. Let's see how well I can do it. When we think about technology, like there are words like these which pop up immediately to your mind, I'm sure. These are common words now, and many of these are very relevant in the financial intermediation space too. You have heard that data is the new oil and analytics is the combustion engine. And because a lot of startups and established firms are relying on technology to gain market share in the intermediation sector, you got to ask how they're doing this. And the way I want to start out by sort of exploring this is to talk about 3 buckets of activities where technology has disrupted intermediation in some ways. So one is going to be higher quality products are made possible with technology. So these are new products. Think about products being more convenient or not being available before. And because these are higher quality products, that means these firms who are providing them can gain market share. So that's one bucket. The second bucket will be lower costs. So you have technology, it makes you more efficient. Maybe also because you're not regulated, again, you are cost effective. So with lower costs, again, you can gain market share. So that's going to be the second bucket. And the third one is something that is talked about more than the other two probably, which is that technology allows for better risk assessment and intermediation, whether it's through better models or big data. And through that, we can do better screening, better pricing of risk, and that means more market share. So now there's truth to all of them, and they're not all mutually exclusive really, but it's easy to talk about them in these buckets because there are examples then I can talk about. So let me sort of talk about what I have in mind when I say about the higher quality. So when it comes to better quality, let's talk about some examples. I'll give you some examples from the US, but there are many examples everywhere in the world of similar kind. So the quintessential example of better quality and huge explosive market share gain from that is in the mortgage household space, where mortgages were provided in a standard way through brokers and banks. And in comes Quicken Loans, which is a fintech firm and provides a Rocket mortgage product. What is that product? Well, it cuts out the hassle. So you enter a few pithy details and immediately it sort of triangulates and gives you a interest rate on your mortgage. So out goes all the hassle. They have ways in which they can aggregate data, which otherwise requires a lot of back and forth between the consumer and the lender. None of that happens here. And you might worry that, is this something that really consumers care about? And there are lots of marketing research firms which do surveys regularly. For example, JD Power here, which sort of finds that customers actually care a lot about the efficiency and speed with which transactions are closed. And in fact, what lots of firms like JD Power do then is that they score lenders on how quickly are they closing the transaction with the borrower once the inquiry is initiated. And if it's very short, then you get a higher score and so on. And what it finds is that Quicken always scores very high on this. So this is convenience provided because you've cut out the hassle. You can ask here that, okay, maybe this is just technology, and how do we know that this is something that consumers are not just, maybe there is a cost element here too. But you can look into willingness to pay for consumers. The dark line here is what Quicken charges its borrowers, and the dotted line here is what the banks charge their borrowers. Everything else the same. And you can see that there is a premium that Quicken sort of charges its borrowers because it's found these borrowers who have a high value of time, opportunity costs are high, they have high willingness to pay, and they target them and provide them a product which is convenient and charge a fee for it. That's one way to think about it. Another example comes from these intermediaries known as iBuyers. So what are these? They buy and sell houses instantly. There are many examples. I've listed two. If you don't know what these are, here is a simple way of thinking about it. You can sell your home from the comfort of your couch. So there is a quicker selling process. There is no need to do a showing. And these firms essentially rely or claim to rely a lot on technology to value the home very quickly based on the hedonics of the home. Then they take the homes on the balance sheet. And because they are taking this risk, they charge you a fee for convenience, essentially. And again, this is something that has exploded in terms of market share. So that's one bucket out there. Let's talk about the other bucket, which is lower costs. So what do I have in mind? Well, the simplest example here is think about how the credit card network works, for example, in the US. So, you have a consumer and a merchant, but you got to swipe your card through a payment processor, which then connects with the merchant's bank, and then everything gets checked there through Visa, which then communicates with consumer's bank. And in the process, there are fees that are charged in different spots. And in comes a disruptor, and basically what it does, it lowers the cost. So, Square comes in, it aggregates all the acquirers' banks and basically cuts out some fees and then passes it to the merchant and to the consumer, and gains market share. So that's the lower cost part of the bucket, which is kind of standard. And then the third bucket is better screening. So the idea here is that because of big data, we are able to somehow get better assessment of risk for borrowers, so we can screen them, and then once we screen them, we can also price risk better. So one example here is this firm Mercado Libre, which is, you can think about it like Alibaba in Latin America. So it has an e-commerce platform, and then it also provides loans to retail borrowers as well as businesses. And this is a study that BIS did. What is shown here is that, like, you have borrowers out there, and there are standard credit bureau ratings for these borrowers. That's in blue. But the ratings are pretty coarse. It's low risk, medium risk, high risk. That's the bottom line here in this slide. And what Mercado Libre does is, because it has information on transactions of these borrowers, it then is able to construct an assessment of borrowers, which is over and above what a credit bureau could give you. So they have information on sales volume and average selling price and reputation related information like claim ratio, handling time, reviews, complaints. They have information on network, like who are you transacting with? And all of these then feed into basically an assessment of risk for the borrower, and they get their own internal score, which goes from A to E, with E being the riskiest and A being the safest. And what you can see here is that within the coarse credit bureau buckets, you can use the internal score to finely grade these borrowers. And you can see within each of the coarse buckets, the y-axis here is the loss rate. So once you give the loan, what you find is that the E borrowers within each bucket default way more than A bucket. So that tells you that there's information you can screen. So this is how Mercado Libre can then disrupt intermediation potentially. The other thing they do is, obviously, once you sort of have a sense of who defaults more or less, the size of the bubble tells you how much loans they are giving. So you can see that they give more loans to folks who are essentially low risk. So that's essentially how you do screening and better risk pricing. Another way of seeing this is the standard receiver operating characteristic curve, where the x-axis is false positives and y-axis is true positives. And the curve is basically when you change the sensitivity of where you define a true match. So you're trying to have a model where if you give a loan, how well can I predict whether someone paid me back or defaulted? And you're hoping that the model goes in the leftmost corner, because that's where true positives are. So if the model says you defaulted and the borrower did not pay back, that's what you want. And what this essentially is telling you is that as you introduce more and more of these e-commerce variables, which is the blue curve, you do much better than just the credit bureau score, which is the red or the purple curve. This is something that is not just, you don't need to go to Mercado Libre. In the US, for example, Cabbage sort of has a very similar model, and so do many, many firms. So what is this? This is like giving loans to small, medium enterprises where banks were not serving them. There was some thin credit bureau information for these borrowers. In comes Cabbage, they says, we'll give you a loan, but we'll need some information about what's your inflow and outflow in terms of the cash flows you're getting. And then if you look at Cabbage's receiver operating curve based on their data, again, you can find that, looking at their e-commerce data on inflows and outflows, you do much better, which is the purple curve, relative to just the external Vantage Credit Bureau score in the US for these borrowers, which is the green line. So that's another example. Finally, one more example is SoFi, Social Finance. So this is a firm which started with refinancing of student debt and has had an explosive growth over the years, has pretty much captured a chunk of this market. And how has it done it? Well, basically by pricing the low risk segment better than what other lenders were doing. And because they were able to do it and offer a lower rate to these borrowers, they have been able to sort of expand pretty dramatically. So lots of folks, lots of similar kind of action when it comes to risk assessment. Now, at this stage, you might think that, the way most of these fintech firms, which rely a lot on technology, the way they have expanded is by picking one of these buckets or combination of these buckets that I showed you, and that's pretty much it. But that's far from the truth. What seems to be the playbook of fintechs is what I call unbundle and then bundle. So you sort of start with some single activity, get deep into it, and then sort of expand and then bundle again in terms of services that you provide. So in some sense, you're unbundling the activities that banks were doing by focusing on one activity and then expanding and then bundling and becoming like a bank yourself. And in some cases, a bank, they do become a bank, and we'll talk a little bit about it. So the simplest way to think about it is if you go back 5-6 years earlier and looked at, for example, the US landscape of intermediation and asked, hey, how did it look? And what I have here is a picture from 2015-16 vintage. And you can see inside various activities of banking. So lending, retail banking, investment banking, wealth management, payments, treasury functions. So that's the activities that banks do. And essentially each of those green dots and black dots are the startups, fintechs, which are disrupting that particular activity. So, the lending side, you have Lending Club, Cabbage, SoFi, and so on. On the wealth management side, you have Betterment, Wealthfront, Robinhood, which used to be small, but now is pretty big. And the biggest activity, of course, is on the payment side, where you have Square, Stripe, all the big techs, and crypto and so on, all in that space. So, payment is the most active. That's something that I'll come back to. But when you look at this, this is how everybody started with one particular activity that they were disrupting. And if you think that, can we get some more color into this? Yeah, sure, we can. Here is one way to sort of think about it, how minute these activities are. So if you look at households and, on the left side, what I have here is just the life cycle of households. So you start working at some point and then you retire at some point. So during that time you consume, but your income is hopefully more than your consumption. So you save and then you dissave after you stop working. And then before you start earning, you might have some debt, so student debt. And you can see that in each of these activities, there are a bunch of different startups or fintechs which have gone in and attacked that particular activity. And whether it's saving, whether it's retirement, whether it's student debt, all of them have been disrupted. And each of those have essentially transacted with the consumer directly and gathered payment information, or liaisoned with some payment aggregator and collected information, because as is well known that payment information is very useful for customization, because in real time, you can quickly figure out what kind of people are coming to your website and what kind of folks are transacting with you and what do they really want. So are they digitally averse, or are they tech savvy, or are they convenience seekers, or are they just for offers? And this idea of using payment information to help customize and offer some products is not a playbook that was just fell from the sky. This is something that essentially came from Alibaba, where Jack Ma sort of pretty much followed this. And if you sort of remember, they started with some peer-to-peer payments and a chat, and then started offering other products based on what information they were getting. So they started with one activity or a couple of activities and then started offering other services and bundling them and providing them together. For example, here is money market management funds, and big techs, which is Alibaba and Tencent of the world, were the ones who were providing a lot of this. So this is something that has been followed pretty closely by firms all over the world. So Mercado Libre did it in Latin America, lots of firms in India are doing it. And here is the same example that I sort of gave you earlier about payment processors. So payment processor, I showed you this picture before, and then Square came in, and Square, of course, had a lower cost that it was providing to different parties, and that was one reason why its market share increased. But that's not where it stopped. It got this information and the data from the merchant and consumers, and then started offering a bunch of services. So they unbundled one activity of a bank, and then immediately, once they had the data, now they, on the seller side, the merchant side, and on the individual side, can provide a suite of services in a bundle fashion. So on the merchant side, you have a card, you have an e-commerce platform, you have a customer engagement platform, you have invoice management, payroll, you name it. On the individual side, again, you can manage your payroll, you can manage your credit card, you can manage your investing and deposits and so on. So this is the playbook which a lot of these folks have, and we'll talk a little bit about why are these folks then trying to become pretty much like a bank, and in some cases becoming a bank like Square did. Now, this is the reason I say this is because it's not to say that technology is the only reason why we have seen this growth. Regulation has played a big role too. In fact, I would argue that much bigger role than technology in many segments. So while we can get carried away by technology doing a lot of magic, the fact of the matter is that regulation has a big role here as well. So one simple example, the most stark one which I have is, if you look at the mortgage space, going back to Quicken's success, and ask the question, hey, like, is it all technology? Well, we can actually look at how regulation changed in the US over the period over which the fintechs and shadow banks gained a lot of market share, because this is the time period over which banks were regulated pretty heavily because of capital charges, lawsuits, and supervisory intensity changing. And there is spatial variation here in the US. And what one finds is that if you look at the changes in geographic penetration, on the left is 2008, lighter color being not enough shadow bank fintech penetration. On the right is a few years later, the darker being shadow bank fintech penetration. So it's increased. It's not uniform everywhere. And in fact, what one finds is that banks retreated in places where regulatory burden increased and shadow banks entered in those places. And if you were to sort of look at this picture in time series, which is what this is plotting the share of shadow banks and showing you that it went from 25 to excess of 60% in the recent times, if you extend this. And if you were to ask how much is regulation contributing to this and how much technology, in fact, 2/3 of this is regulation and 1/3 is technology. The reason I'm sort of emphasizing this is because when I talk about challenges of thinking about intermediation going forward, one of the challenges is to figure out where the risk is outside the banking sector. And increasingly, there is a push towards thinking about regulation of shadow banks and fintechs and so on. But if the comparative advantage of shadow banks and fintechs only comes because of the regulatory arbitrage, it's not clear what's going to happen once, besides there being many, many more intermediaries doing the same thing, once regulation sort of kicks in for these things. It's pretty similar story for social finance. SoFi, I showed you earlier. SoFi was able to do a better pricing of risk for low risk borrowers because the market was government dominated and there was no risk-based pricing pretty much. So they did some cream skimming. Now, is that technology? It's very basic technology. It's essentially regulatory arbitrage. Similarly, when you think about Cabbage, yes, they went to small, medium enterprises, but that's because banks were being regulated and not allowed to lend to that space. So, there is a lot of action which I think regulation sort of kicks in. So the fact that shadow banks are growing so much because of regulatory arbitrage then begs the question that why is it that some folks, when they're unbundling and bundling and sort of becoming like banks, actually do become banks. So SoFi has become a bank. Square has become a bank. A lot of other folks want to become a bank. And the question is why? Well, the reason is that I've told you a lot about the asset side of the banking, but I've told you nothing about the funding side. So when it comes to funding side, there is one thing that you should know if you didn't about banking, which is deposits are cheap. And because deposits are cheap, they matter for whoever is looking for funding. So yes, folks know that they might be regulated, but maybe the benefits of getting a pretty stable source of funding, which is cheap, far outweighs any costs that you might be worried about. And especially if you have become a pro at managing regulation once you've become large. So you might think that deposits are cheap, but like really, like, do folks really care about this? So this is a study that we sort of did some time back, where the dotted lines here, the orange line here is banks, and you can see that their equity to asset ratio is pretty same for regardless of what the size of the bank might be. And in the black and gray is shadow banks, which are banks which are not regulated. They don't take deposits. And if you look at their capital structure and equity to asset ratio, and they do the same activity as the banks, but their capital structure varies dramatically over size. In fact, it's pretty similar when it comes to big banks and big shadow banks. Their capital structure is similar in terms of the overall equity to asset ratio, even though the composition is different, because banks are taking money from deposits, while big shadow banks are taking money from commercial paper and so on. But if you look at small banks versus small shadow banks, the gap is huge. And that tells you that small banks really love deposits and lever up pretty dramatically. And basically, using this fact, we are able to back out how cheap deposits are. And the fact of the matter is they are pretty cheap for small banks. And that could be one reason why, despite regulation, which will be a deterrent to the growth of many of these fintechs who have bundled, they are still okay going ahead and going for deposits. All right, so let me talk about now the last couple of things that I wanted to sort of mention. So given all of this, there are some challenges that regulators face, and as academics, we can also learn quite a bit about intermediation and what do banks do and how intermediation might change going forward. So one is thinking about stability-based regulation. One action that has happened here is a lot of risk has migrated to the shadow banking and fintech space because they've gained market share. And so one simplest example here is in the mortgage space. For example, in the US, if you look at the most riskiest segment of the market, it's the FHA market. And you ask, where is a lot of these loans sitting? They are all with non-banks and shadow banks, not with banks. So on the left is when you buy the home for the first time, and on the right is when you refinance your home. Regardless of which market segment you look at, it's basically an activity which is being done pretty much by shadow banks. So when you start thinking about this, you got to worry about what kind of risk is going there, because it's not like any activity does not uniformly migrate to shadow banks. It's moving to shadow banks because they have a lower regulatory burden. That's why it's important to understand what the comparative advantage of shadow banks is. So if it's moving to them because of lower regulatory burden, that means when we are trying to figure out how much risk is outside, you can't just look at the banking sector and say, let's scale it up by a factor of 2 because half the activity is outside, because it might very well be that the most risky activity is outside. And in fact, if regulatory arbitrage is the primary reason, that's exactly what you should expect, that the most risky part of the activity is in the shadow banking sector. That's not great for us trying to figure out how stable the intermediation sector is. So there is a shadow bank migration margin because of lower regulatory burden. The second thing that becomes very tricky here is that the banks also respond to this competition that they are facing from shadow banks. So they can also do the same kind of things that shadow banks are doing in terms of originate to distribute, for example. And, but they also face a capital constraint. So that capital constraint is going to interact with what banks can do or cannot do, and where they can do and what they can't do. And essentially, you got to think about putting shadow banks and traditional banks together, figuring out what their business models is, where is their funding coming from, and what is their comparative advantage. Put it in a framework where you can understand the competition where it's happening, and then figure out the equilibrium. Without this, it's going to be very, very hard to sort of get a grapple at this. There are some crude ways in which policymakers want to go at this, which is, let's scale this up. Let's look at what banks are doing and then scale it up by some factor. That's not going to work. And hopefully that's clear from what I'm sort of suggesting. The other challenge is how far can we take the insights from data before we know that there is lack of economics and too much statistics potentially. So, one insight here is that, this is something that everybody knows, essentially, that if you look at big data and analytics, and if there's a regime change happening because the data generating process changes because of technology or incentives or something, when you estimate the data, estimate a model based on data where the regime was different, you're going to find that that model is going to perform very, very differently. So, for example, here is the big data example from back in the subprime crisis, when the rating agencies were basically using big data, trying to predict default on loans. And the problem was that as the intermediation changed dramatically, it went from originate to hold to originate to distribute. What it meant was that if you estimated your model in the originate to hold era, you were estimating it on a pool of loans which were much different than pool of loans when the intermediation was originate to distribute. And in fact, originate to distribute had the problem of adverse selection, and as a result, the model that you estimated in the pre-securitization era would tend to be telling you that the defaults would be much lower than they would actually be. And in fact, you find that. So what's plotted here is mean errors. So what's the true default minus what the model is telling you? And the positive here means that the model is under predicting. And what's telling you is that progressively, if you estimated the model from 95 to 2000, for example, which was originate to hold era, and then as the securitization in this market increased, what you find is that this model under predicts in a pretty systematic manner. So this model is not just giving you noise, classical noise, it's giving you a systematic error. And the error is because you have not accounted for the fact that the regime has changed on the ground. And that's something that one has to be careful about when it especially comes to these fintechs and data scientists who are going to be using this without necessarily understanding the nature of banking, because ultimately the data generating process comes from the bankers doing whatever they do. Another sort of example, which is a slight variant of this, is the notion. So this is when regime changes. You could also imagine over-reliance on models or taking too much risks from the model, especially when there is economic distress. So here is another example closer to date. So Zillow was also into the iBuying business that I told you about earlier, and it recently took $400 million right down because of losses. Remember that their businesses, they buy quickly using their model and then charge you a fee, which means they pay you a lower home price than what the model is telling you, accounting for the convenience that they're providing you. Now, what did Zillow do? Well, essentially, because they were not very profitable in the beginning, they tried to over compensate by using their model and relying it on doing over-reliance on their model in some sense. So they not only were bidding exactly what the model was telling them, but sometimes even more. And the other thing which they didn't realize is that when you make these offers to homeowners, there are going to be those who are going to step forward who suffer from adverse selection, because they're selling it to you because they don't want anybody to come in and do the inspection, because they know the value of the home is going to be probably pretty low. And they're hoping that they'll get away. And if you don't account for that, you're going to suffer a lot of losses. And Zillow, because it was in a hurry, went and over-relied on the models without accounting for these things and ended up in a big mess. Now, the reason I'm sort of mentioning this is because a lot of these fintechs who have done risk pricing have done so in an era of low defaults and low interest rates. So it remains to be seen how they account for changes in regimes and changes in economic incentives of agents and adverse selections and so on as they go and make predictions going forward. The last challenge, which I think is also pretty important, is harmonization of regulation. So what do I have here? Essentially, there is this mantra that regulators are now sort of saying everywhere, that if you are a fintech or a startup and you're relying on technology, but you're doing the same activity as banks, you probably need similar kind of regulation. So this is what I was getting at earlier. So what comparative advantage will remain for these big fintechs who have unbundled and then bundled? If they are relying on regulatory arbitrage, that will be gone. If it's technology, what kind of technology is it, and what activities will be impacted? Because remember that most of these fintechs are now complex animals. They are like conglomerates. So which activity is going to be impacted? What kind of data are they using? Are they allowed to use that data? And that gets to this whole notion of the data sharing issues that are also cropping up. So there is this whole push towards doing open banking, which is that banks used to transact with customers, had their data, they were like a monopolist. And now we want that data to be available to third parties, because now we can then use that data to provide better service and products to customers. Clearly, there is something to that. The problem is that, as I've shown you, if you look at the different categories of technology, the risk assessment technology piece definitely relies on data, and that data is of the e-commerce nature. Those are not just fintechs; those are folks like Amazons of the world. And if you are going to allow those folks to access banks' data, but banks are not able to use their data, they have axe to grind here. That, why is data sharing not symmetric? Why are banks being asked to provide data, but not all of these e-commerce folks who are completely outside the purview of banking regulators? Because ultimately, these other folks are also providing financial products and collecting information, which banks could then use to provide potentially some different products. So that's going to be an interesting conversation and difficult one. There is the issue of monetization, like when you have this data, how do you split the surplus between customers, different parties, and the banks? And how do we watch out for where the line is? Because as lots of research shows, that when you're looking at figuring out which segments to serve for convenience or for risk assessment, there is a tendency for these models, especially which rely a lot on data, to rely on non-linearities, and you can easily end up with situations where you end up discriminating some borrowers at the expense of others, or you might end up exploiting biases. So how are we going to sort of draw a line here? This is going to be a pretty tricky situation going forward, but it's pretty central to the whole technology angle, because technology at the end of the day here, a lot of it is about data. So let me conclude with a few open questions. So one is, why did banks not innovate already? And all these questions will get to the economic forces of financial intermediation, both in terms of research and for policymakers. One argument here is that, well, they didn't do it because they had enough rents. So as monopolists, why did they need to innovate? I don't know if that's the case. There's certainly some research which suggests that they seem to argue that that's happening. Or it could be that banks did not innovate because they were not allowed to, because of regulation. So if that's the case, when regulation will come on fintechs, what's going to happen there? Obviously, how to balance regulation with incentives for innovation is very central. If you look at the innovation data in the US and in terms of patents that fintechs are producing, you do find that most of the patents are in the consumer space, in the retail space, lots of them. But lots of them are relying also on data which regulation does not allow banks to use right now. So when that homogeneous regulation is applied on fintechs, will they be able to do it? Maybe the best way to sort of think about it is something like what Singapore has done, which is, you have a sandbox where the regulator allows fintechs to work together, and then there are collaborations with banks. Rest of the world is going to be a little bit more trickier. Regulation, lots of regulators have their own turf wars, and especially in the US, for example. And then you have to coordinate across all of these regulators, and it's not obvious how and what is going to happen here. And then finally, when it comes to technology, technology is doing great things, but there are limits to technology as far as I can see. So one is the insights from the data, for reasons I already mentioned, that big data does not always mean insights, because you've got to get the economic arguments right as well. And then the second thing is, if you look at lots of what these new products are, and when it comes to convenience, for example, you're targeting consumers with high willingness to pay. So, when it comes to iBuyers, it's easy to price homes where you can do your hedonic model very easily. Or when it comes to Quicken, you are looking for folks who are willing to pay a premium to get stuff done without hassle. So you're looking at more credit-worthy borrowers. So, are there limits to technology that we are serving consumers who are already getting served in a reasonable fashion? How are we going to go to consumers which are not served very well? That remains to be seen, and how we are going to be able to grapple that with regulation is something that I'm hoping we'll get an answer to soon. So with that, I think I'll stop.
We shall now begin the moderated discussion and Q&A segment. So I would like to invite Professor YEUNG back on stage to moderate the segment. Professor YEUNG, please.
Amit, thank you very much. I really don't know how you do it, but you're giving us a very comprehensive and very detailed and very insightful lecture on this topic. Normally, I would like to, ask questions and so on, but I understand that you have been working for a long, long time. So maybe I won't ask questions, but I'll leave it to the floor, because I see here many practitioners as well as academics who are very keen on understanding more about this topic, and they have done a lot of research on their own. So may I turn to the floor first? Anyone who would like to start? Steve, please. Steve Davis from Chicago.
Great. Thanks for a really interesting talk. Just a couple small questions, since nobody else spoke up yet. Once you showed that the equity to asset ratio is larger for the relatively unregulated part of the financial system, but that's exactly what we would want, at least with respect to some kinds of risks. If they're taking on risks that we don't want the banking system to take on, well, the price of doing that is you have to put up more equity at risk. I just wanted to get your reaction to that and see if you thought that this might somehow be a quasi-optimal structure. And then the second thing, and this is not a totally formed thought, but it seems to me there's another candidate explanation for why certain innovations haven't taken place in banks. I fully buy your story about regulatory arbitrage. I just wanted to get a sense of whether it's more than that. So this process that you emphasized of unbundling and then rebundling. Okay, the fact that you keep getting this rebundling suggests that there are some sources of private efficiency gains associated with that rebundling. You pointed to the access to deposits, which certainly makes sense, but I wonder if there are other static efficiency gains that arise from cross-selling and so on. And then here's the question. Is there something about a bundled financial institution that just makes them less able, not for rent reasons, but technologically less able to innovate in the ways that the fintechs have done? And so that we should expect to see the natural life cycle of successful organizations in the financial sector, at least many of them, is they have an idea, they innovate in a certain part of the space, they've exploited their one idea, so what's left to do is to exploit these cross-selling and try to take advantage of the static efficiency gains. Is that a plausible model for what's going on? It seems like a logical possibility, but I really have no idea whether there's any empirical merit to this view of why the innovation didn't happen in the traditional mainline banks first.
So thanks, Steve. I think both very reasonable observations. I think on the first one, you're right that if we sort of see the non-banking space as being better capitalized, that seems like a quasi optimal structure. The question then becomes like, do we need 6,000 banks in the US, who are many of whom are just living off the deposit subsidy? Because to, like you said, that the risky activity can be supported by a market outcome, which is higher equity to assets ratio, which is totally fine. The problem there is that I didn't show you the numbers, but there's a chunk of US banks which are just essentially surviving, I think, pretty much on deposit subsidies. So, but I think we are in agreement there. On the other thing, I think you definitely are pointing to something which is likely true. There is some economies of scope or scale here which are in play. Unfortunately, or cross-selling or whatever you might want to call it. Unfortunately, like if you look at the literature on banking, it's been hard to identify these things cleanly because it's hard to get this data. I think it's likely that the fintechs and these technology players are probably using some of this data better. What I don't know is that are they also using the data in ways that violate things like privacy and so on? I have no way of knowing that. I know for a fact that banks are not allowed to do a bunch of those things. But I think this is something that needs to be explored. I think we are at a very basic level, we don't fully understand how large economies of scale and scope are in banking. And what you're getting at is essentially asking me what those are. And I think the fact that a bunch of these folks have decided to operate in a pretty bundled fashion maybe provides us with experiments to be able to tease that out now.
Maybe, Amit, let me ask a question myself here. I mean, we are talking about technology and intermediation. I mean, the technology going to better serve the customers and make more profits. This is always the case. But conceptually, I'm thinking about what you say here, that at the beginning, the banks, they know what the customers want, and they come up with technologies, and so you serve the customers, like for the ATMs, a credit card, and all this thing. But now the table is turned. It's that technology came out first, and then they find ways to serve the customers, and they gradually disintegrate the bank's bundled service. And so in a way, there's like the two-way approach, the bank with technology, and then the big tech with technology. And now in one of your slides, you were saying that there will be an integrated intermediation model. So for the benefit of the practitioners, many are online and here, let me ask you the question. What do you see as this future integrated intermediation model would be like, the combination of banks and big techs? And then I speculate that this evolution will have a lot of path dependence. And when it comes to path dependence, I'm thinking about the model in North America and the model in Europe and the model in Asia are all very different. So would you mind to comment on this future integrated intermediation and the path dependence and how these three places would evolve?
When you're asking me to write dissertations here. But
there is nothing that you cannot do.
So I think when it comes to this whole integrated intermediation, the point here was just that as regulators and as academics, we want to understand that the activities that are happening are not just siloed inside the banking space anymore. But leaving that aside, I think what you're asking is how do I see this evolving? I think one of the reasons why regulators have acted a bit slowly is they are worried that banking has been a space where innovation has always lagged behind. So, yeah, ATMs and credit cards, but then we didn't have much action, except in the last 10 years. And I think people are still trying to figure out what's the right lever to push in terms of how much regulation to put on these new fintechs, so that it does not stifle this innovation. Because banks are responding to this, like you said, they responded earlier and they responded now. So when you look at payment processors like PayPal's of the world, banks had to come up with their own payment aggregators to respond. Banks are sort of doing that same kind of thing. But if we try to tighten this too quickly, there is a worry that a lot of innovation might disappear. Having said that, I think these are extremely complicated issues, if you ask me. Typically, we only had to worry about financial stability when we worried about capital regulation, for example. It was only financial stability. Basel I, Basel II, and so on. And even that was so difficult to manage across the world in terms of implementation and enforcement and so on. And now we are talking about financial regulation, data regulation, and competition related regulation, which I didn't even talk about, but that's related. Because when you think about these big techs and fintechs, as they become bigger and they have data, they also tend to have monopoly when it comes to getting assessment on consumers. Like I was telling you about open banking, right? Open banking is, okay, banks are open, but fintechs and big techs are not open. So, they have a lot of insights that they are basically going to exploit. Similarly, when it comes to talent, a lot of talent wants to work in places where there is data and where they can run models and so on, and they tend to be big tech. So there is a competition angle. Competitive authorities also need to sort of think about these things. And this is a pretty complex set of prediction to make. And I agree with you, there'll be some part dependence. If you look at Europe, Europe has been very aggressive, but I think Europe traditionally has had more innovation when it comes to the financial intermediation space through banks than, for example, US. If I look at Asia, like Singapore, for example, Singapore, the regulator is trying to be very careful in trying to make sure there is a harmonious relationship between startups and banks, so that they are separate, but they still collaborate. I think India and China tried to do something similar as well. How successful it'll be, it remains to be seen. But yeah, I don't think I can give you a clear answer to what you're hoping to get from me on this.
Thank you, but you already stimulate further questions. I'm going to pick up two questions this time. Table, yes, please. Yes,
One
please.
way in which the traditional financial system has participated is actually arranging financing for all these innovation and doing in a number of innovative ways, like venture capital, private equity, and so on and so forth. At the same time, we do not see non-banking entities substituting banks in collecting deposits. So I wonder whether this big picture fact is telling us where the system is heading. Maybe fintech is just peeling off some non-core essential activity from traditional intermediation.
Thank you. You want to raise your question now? Okay, afterwards. So, Amit, please.
If you look at many of these folks, actually they are peeling into deposits as well. They just don't call it deposits. So for example, if you look at PayPal, PayPal, if you look at the number of pseudo deposits it has, it would be in the top 15, 20 banks in the US if it was a bank. So they are peeling into pseudo deposits. So if you take an Uber, for example, or a Lyft, they ask you to keep some money in the Slack account, which is like deposits for them when you aggregate it over a pretty big base. In terms of where they are getting funding, you're right that like, I think they haven't had to worry about this so much, to be honest, because we had a low interest rate environment and there was enough funding available everywhere. But my sense is that now that the interest rates are pretty high and are supposedly going to remain high for some time, they might actually find tapping deposits much more lucrative. So the fact that you have seen some of these guys becoming banks, I can imagine more of them want to become banks because deposits are a pretty lucrative source of funding for them. But they have tried even without that, but not as much. And I think that's likely to change. And yeah, I think in the past, there was enough soft bank money and venture capital money that they didn't have to worry about this. But those days are quickly going. So I expect that to change.
I hope that you're holding up well. May I take two questions from one of our sponsors, GIC, Prakash and Will you please? May I take the two questions together? Okay.
Hi, hello. Hi, Prakash Kannan from GIC. I guess this question is really related to that insight that Professor Seru made in his presentation, which is that big data does not necessarily equate to good insights. Because I think a lot of the times we have kind of good cross-sectional data, but maybe not a lot of time series. But we've just experienced a big shock in the form of the pandemic. And I was just wondering whether there were any lessons that we have learned coming out of that episode. And I'm just thinking of two specific ones. So one is that it was assumed that there is a benefit for a relationship between a bank and a customer, such that even during hard times, that kind of flow of credit is retained. And whether we saw that that shift during the pandemic. That's one. The second one is whether there's some spillovers from kind of broader policy support that help the regulated sector, but also kind of spilt over in a way to the fintech / unregulated space.
I think there were some lessons. I think you're right that this was a pretty big shock. I think a couple of things happened. One is this gets to the question that the previous person had asked, which is about reliance on deposit funding. So fintechs had tons of funding and there was no problem. And then pandemic came. And if you remember, there was a period of a month or 2 months when everybody panicked and there was no funding. And these folks, the fintech firms, suddenly had to worry about funding when they had not worried about funding for the last 8-9 years. And that was a wake-up call because it stifled their growth during that time. If you remember, in the US, for example, there was lots of funds that needed to be channeled to small, medium enterprises, the PPP loans. And because fintechs are a reasonably big part of that segment, there was a lot of belief that fintechs will help channel that, even if banks can't. And turned out that banks were the ones who did it. And fintechs couldn't because they just didn't have balance sheet capacity. They didn't have enough funding available. So I think that was one lesson because of which, again, I think fintechs are going to worry about funding more than they have. And that means looking for things like deposits and becoming banks themselves. The second thing I think, which is not so good, I think from the pandemic, besides many other not so good, is there was a lot of forbearance related policies that were passed all over the world, right? Like where we pretended by extending, we didn't foreclose or default on loans because we gave forbearance to households and to corporations and so on. So what that has meant is if you look at the fintech models, their risk assessment is basically not going to work during this time because everybody is essentially the same, right? So there's no discrimination in terms of the signal versus noise during this time period that could be useful for them. because of these forbearance policies. So it's a very strange period where when we come out of this pandemic at some point, and now the interest rates are high too, they are going to quickly find that their models are very stressed and not performing as well, because for a good period of year and a half, 2 years, there is no data. And then now the data is in a high interest rate regime, which they have never modeled. So I expect some chaos at least in how they think about this. But they'll be learning there.
Would you? I saw two hands. How are you holding up? Would you take these two last questions?
Sure.
Thank you. Will, please.
Hi, this is Will Oswald, also from GIC. To follow on from Prakash's question on what we learned from the pandemic, we saw the central bank, the Fed in particular, moving from lender of last resort into buyer of last resort, so really kind of evolving their role. With the growth that you're describing in the fintech space, how do you see the role of the central bank then developing to keep pace with that, and where do you see the gaps are between where central banks are today in their ability to respond to downturns and some of those gaps, and where they would need to be in the future?
There's a big gap. Some countries, the gap is more than others. I think US has a pretty big gap. I think Singapore less so. Europe has a better sense. And I think part of the reason is, again, there is a lot of innovation that has been allowed in the US, which is a good thing. But that has also meant that a lot of risk has moved into spaces outside. Some of that risk is funded by banks. So you need to worry about that, but I don't think people have a good sense of that. Some of that risk is going to be held by some other government entities. So there are these entities known as Freddie and Fannie, which basically control 95% of the mortgage market, which is a big chunk of household debt in the US. And they are essentially buying a big chunk of their portfolio from fintech players. So there is risk in the system, and there aren't market forces out there which are pricing this risk appropriately as we would like. So there are pockets where suddenly there's market forces working, but then there are other pockets where you have a government regulated entity potentially mispricing risk. So as a result, I'm not very confident that that we are doing a great job. So in the US, I would say innovation-wise, it's great, but I think in terms of understanding the gap between where the banking sector is and where the shadow banking sector is huge. It's not so much in other parts of the world, but at the end of the day, given the nature of intermediation, global nature, there needs to be some understanding across regulators, and unfortunately, I don't think pandemic has helped there. I'm hoping that changes.
Well, given what you've said, I think it's most appropriate to give the last question to Governor Subero.
Thank you very much. Well, I've been a bit disappointed by one of your concluding observations. If I got you right, what you said is that technology has been able to reach customers, borrowers who are already have a high willingness to pay. They're already getting loans. So technology has helped them benefit by way of lower rates and more efficiency. But I thought one of the big promises of technology is also that it deepens financial inclusion, is able to make a credit evaluation of people who've never been in the credit market. For example, by studying their online browsing pattern, by studying how, where they make calls from, if they have fixed time calls, so that whether they have a steady job or not. So don't you think technology has a promise in deepening financial inclusion?
It does. That's why there was a question mark. I think what I'm sort of getting at here is that we don't have a good sense right now of how big that value add is. Yes, there is potentially, we can thicken the credit file, which is thin, by tapping on more sources of information. The problem is it's unclear what sources of information are reasonable or not reasonable. As a fintech, as a startup, you don't think a lot about that. As a regulator who is thinking about consumers and privacy and exploiting of biases and so on, you do think about that. So when that triangulation will happen, I'm not sure how big that space is what I was sort of getting at. Certainly, it seems reasonable to think that we must be able to thicken some of the credit information out there. Having said that, when banks many times don't lend to someone despite doing a self-evaluation, that tells you something, right? Because banks have been in the business of doing this. So my worry is that we rely too much on garbage in, we get garbage out. That garbage out gets hidden when the interest rates are low and things are great. But when the interest rates are high is when we will truly find out what's the value of this whole thing. Because if you ultimately ended up lending to folks who were not very credit worthy, well, banks were not doing that for a reason then. And we didn't really create a new market. So I'm just a little bit skeptical, but that's not to say I'm not optimistic that there's something there.
The very insightful answers. I think we have to bring this to a conclusion. I want to say thank you to two entities and to you, and also ask you to part with us some advice. I want to first thank OUE for supporting this event. I want to thank GIC for supporting the ABFER events. Thank you very much to the two supporters. And I want to thank you, Amit, for you take on a very current, important topic, and you categorize them, systemize them into various areas, and provide us with the way to think forward about this. When I ask my question, I'm really thinking that the book is just beginning, yet to be written. And it will be written by researchers here, it will be written by practitioners here, and would quite likely be written by your students. And you research a lot, you think a lot about this topic. So I want to ask you for your advice. When you're finishing your class, what are the 1, 2, 3 things you want your students to remember? Or I would mean it's like for us to remember at this juncture. Thank you.
I think
any attempt, any answer? It's not writing a thesis, it's just telling what your students, what you would say.
I think right now being safe is one of the most important things.
Sorry, what?
Being safe.
Yeah, well, thank you very much. We really owe you a lot, and I know this is approaching 5 a.m. in the morning for you. Thanks for holding up the whole night and working with us and giving us this wonderful opportunity to learn from you and from the audience. Thank you, and I want to thank the audience too for your questions. Thank you very much, and keep safe and get better.